Welcome back to the second part of Topic 7 lecture. There are more to come, and here we are going to cover 6 to 10. So let's get started. Our first stop in learning Objective 6 is the discussion of the key assumptions of CVP analysis. The assumptions are important to understand because if, for example, you are assuming something that is not correct, then your analysis will be wrong. I remember when we went to New Zealand at one time and we were watching these people who are bungee jumping. When you do bungee jumping, I'm sure that you are assuming that the rope will hold your weight. That is the major assumption. What happens if your assumption is not correct and the rope for which you are clinging on to dear life is not strong enough to hold your weight? Well, you will just jump and not return, isn't it? So it's important that when you are conducting CVP analysis, you know these assumptions and that these assumptions hold true in order for your analysis to be correct. So what are these assumptions? Number one, we assume in our CVP analysis that the selling price is constant throughout the entire relevant range. So this means that the price of the product or service will not change as the sales volume varies as long as it is within the relevant range. Second assumption, we assume that costs are linear again over the relevant range. So what do we mean by this? So this second assumption carries a few specific assumptions. First, it implies that the expenses can be categorized either as fixed or variable. Total fixed expenses will remain constant as activity changes, and so it will be linear, straight line. And the unit variable expense remains unchanged as activities varies. It's the unit variable cost that will remain unchanged, but the total variable cost will increase proportionate to the volume of production or activity. All right, so that's still linear. Second assumption that goes with costs being linear is that the efficiency and productivity of the production process and workers remain constant. So we are not taking into account here the efficiencies of the workers. As they become more efficient, it takes less time for them to produce the product. We are not taking that into account. All right. The third assumption is that in a multi-product analysis that we just did in Learning Objective 5, we assume that sales mix is constant. So in our second illustrative example of this sweet smell company that produces 3 types of perfume, Adore, Beauty, and Cutie, if their sales mix did not happen as planned, whereby Adore is supposed to sell 1/10 and Beauty is supposed to sell 5/10 or 50%, and Cutie is supposed to sell 4/10 or 40%, if the sales mix did not happen as planned, even if we actually sold 150,000 bottles, we will still not break even. All right, we could be making profit if we sold more of the product that has higher UCM. Like Adore has $60 UCM compared to Cutie that has only $20 UCM. So if we sold more of the product that has higher UCM, we'll be making profit, even if in total we sold 150,000 bottles. But if we sold more of Cutie, the product that has less UCM, then even if we sold 150,000 bottles, we will still be making a loss. All right, so that's one of the key assumptions. Sales mix must be constant whenever there is multi-product analysis. And the fourth assumption is that in manufacturing firms, we assume that inventories do not change. What does that mean? We assume that units produced are all sold. Therefore, there's no change in inventories. All right. So let's move on to learning objective 7. we will learn the contribution income statement format here, and we'll compare it with the traditional format. The traditional format of income statement is commonly used, and that is following the absorption costing format. This is where you will have your sales minus cost of goods sold equals gross margin. Then you deduct your operating expenses to get your operating income. And then you deduct the tax to get the net income. So up to this point, we are ignoring tax. So after deducting operating expenses from gross margin, we'll get the net income. All right, so that's the absorption costing format. What about the contribution income statement format? You've already seen this in the previous slides. This is where you will have sales minus all your variable costs. So you will have your variable manufacturing, variable selling, variable administrative costs. Then once you have deducted all these total variable expenses from your total sales, you'll get contribution margin instead of gross margin. Then from contribution margin, you'll deduct all your fixed expenses to get to your net income. So this is also known as the variable costing format or the contribution income statement format. So why the two formats? Well, their uses are not exactly the same. The absorption costing format or the traditional format is used primarily for external reporting purposes. And that's why in your financial accounting, that's the format that you normally use. But the variable costing format is used primarily by management. So why the two different formats? Well, the contribution income statement format, also known as the variable costing format, is helpful for managers in judging the impact on profits of changes in selling price, changes in cost, or changes in volume. So the emphasis in the variable costing is on the cost behavior, and that's why it's important for us to be able to classify costs as to whether they are variable and whether they are fixed. Notice that the net income calculated under both absorption costing and variable costing format are equal in this example, and that's only because production is equal to sales. So the only time the variable costing and the absorption costing format will have the same profit is when production is equal to sales. Now let's go to learning objective 8, where we will learn to calculate and interpret two measures of risk. First is margin of safety, and the second is the degree of operating leverage or DOL. So let's start with margin of safety or safety margin. This is simply the difference between your budgeted sales revenue or your actual sales revenue and your break-even sales revenue. This is the amount by which the sales can drop before any losses are incurred. All right, so let's go back to the Curl Inc. example. Currently, their actual sales is 500 units and their break-even sales, as we have calculated, is 400 units. In this case, if we are to calculate the margin of safety in dollars, we can see that our actual sales is $250,000 and our break-even sales is $200,000, and so our margin of safety in dollars is $50,000. Our margin of safety in units is simply 500 units minus the break-even units of 400, and so the difference is 100 units. What about margin of safety percentage? It's simply margin of safety divided by the break-even point times 100 if you are showing it in percentage. So margin of safety percentage is $50,000 divided by the break-even sales of $200,000 times 100, so that will give you 25%, or if you calculate it using the units, it will be 100 margin of safety in units divided by the break-even point in units of 400 times 100, so that's 25%. So how do we interpret margin of safety? Well, Curl Inc. sales volume can drop by 25% before losses are incurred. So margin of safety gives you a feel for how close your projected or your actual operations are to the break-even point. So what do you think? The higher the margin of safety, the better, the safer would the company feel, or the lower, the better? Well, if you are driving by the cliff and you are so close, you are having very narrow margin of safety. So you are at risk of falling over. So if your margin of safety is very small, it's very easy for you to go in the red or to suffer losses because you do not have that much of a cushion. All right, so a 25% margin of safety would be much better than a 10% margin of safety because you have that 25% cushion before you suffer any loss. All right. What about DOL? Degree of operating leverage. It's also a measure of risk. DOL is simply the extent to which an organization uses the fixed cost in its cost structure. Cost structure of an organization is simply the relative proportion of its fixed and variable costs. All right. So the higher your fixed costs are, the higher your DOL would be. The lower your fixed costs are, the lower DOL would be. So let's calculate DOL and then interpret it. DOL is simply the total contribution margin divided by the pre-tax profit. All right. So in the case of Curl Inc., we know that our total contribution margin at 500 units, our current operation, is 100,000. It's simply the UCM of 200 times the 500 units sold. So that's 100,000. So 100,000 divided by the pre-tax profit. Our pre-tax profit is 20,000. So 100,000 divided by 20,000 will give us a DOL of 5. It's a factor of 5 or 500%. There's another way of calculating your DOL. Is simply the total fixed cost divided by pre-tax profit plus 1. So our total fixed cost is 80,000 divided by the pre-tax profit of 20,000. So that will give you 4 plus 1. So it's still the same factor of 5. So regardless of which formula you use for DOL, you'll get the same. What's the significance of having a DOL of 5? Well, the operating leverage is a measure of how a percentage change in sales will affect profits. So if, for example, Curl increases its sales by, say, 20%, what will be the percentage increase in the net income? So a 20% increase in sales will affect the profit by not 20% increase, but I tell you what, it's 100%. How did that happen? So the percentage increase in sales of 20% will be magnified by the DOL, and the DOL is 5 as we have calculated, right? So the operating leverage is 5, so 20% times 5, percentage increase in profit will actually be 100%. That's good, isn't it? So anytime you increase your sales by 50%, how much will be your increase in profit? It will be 50% times 5, 250%. All right, so your increase in sales will be magnified by DOL in terms of your profit increase. So can we prove that? Well, currently Curl Inc. is selling 500 units. A 20% increase in that would be what? 500 times 20%, 100. So if we sell another 100 units, we will be selling 600 units, right? How much would be the increase in profit? Well, currently at 500, we're making a profit of 20,000. If there will be an increase of 100% in our profit, then that means our profit would be what? 20,000 now. It will double, right? 100% of 20,000 is 20,000. So that means our profit would be 40,000 if we increase sales by 100 units. And we can prove that by calculating another column for 600 units. All right, so 600 times 500 is our selling price. Our total sales will be 300,000. 300 is our variable cost, so 600 times 300 is 180,000. So that gives us contribution margin of 120,000. Our fixed cost remains the same at 80,000, and so our profit is 40,000. So as you can see, we have doubled our profit from 20 to 40,000, even with just a 20% increase in sales revenue. Why is that? Because the DOL of this company is 5 times. All right. So the higher the DOL, the higher will be the impact on profits for any increase in sales. So isn't that good? Well, you might say it's good, but it's a double-edged sword. If your sales decrease by 20%, by how much would your profit decrease? 20% times 5, it will decrease by 100% too, right? And you can see it from here. A 20% decrease in sales from 500 to 400 will give you a profit of 0. It's correct, isn't it? We used to have 20,000 profit. 100% of 20,000 is 20,000, and therefore our profit would be 20,000 less, and that's exactly what it is, 0. All right. So, few things to remember with DOL. All right. A firm with proportionately high fixed cost has relatively high operating leverage. So that's why I said the higher the fixed cost, the higher the operating leverage. Firm with high operating leverage has a relatively high break-even point as well. Why is that? Because the fixed cost will have to be covered before the company can make profit, right? So that's why break-even point is fixed cost divided by UCM. So the higher your fixed cost is, the more you need to sell in order to just break even. So that's why DOL is actually a measure of risk. The higher your DOL is, the better it is when there is an increasing demand in your product or service. But when there is a downturn in the economy and your demand for product or service decrease, then you are more likely to make a lot of losses because your DOL magnifies the decrease in your sales, affecting a much bigger proportion of decrease in profit. All right. Let's go to Learning Objective 9. In Learning Objective 9, we'll understand the implications of ABC for CVP analysis, and we'll be aware of the effects of advanced manufacturing technology on CVP relationships. An activity-based costing system can provide a much more complete picture of cost-volume-profit relationships, and therefore it provides better information for managers. The traditional CVP analysis focuses on the number of units sold as the only cost and revenue driver. Sales revenue is assumed to be linear in units sold. That's one of the key assumptions, right? Moreover, costs are categorized as fixed or variable with respect to the number of units sold within the relevant range. So in a traditional product costing system, costs are assigned based on a single volume-related cost driver. As what we've learned in topic 5, an activity-based costing system provides a much more complete picture of the CVP relationships, and therefore it provides better information to the managers. So the point of this section and this learning objective is really that ABC provides a richer description of a company's cost behavior. Just as ABC can improve an organization's product costing system, it can also help facilitate a deeper understanding of the cost behavior and CVP relationships. But the formula that we are applying, whether it includes ABC or advanced manufacturing systems will still be the same. Break-even point is equal to fixed cost divided by UCM, for example. A company that's moving towards just-in-time, JIT, and flexible manufacturing might have overhead costs like setup, inspection, material handling, and these are considered fixed costs with respect to sales volume, but they are not fixed with respect to other cost drivers. So this is a fundamental distinction between the traditional CVP analysis and an activity-based costing CVP analysis. We will have a tutorial question on this, so you will see the implication of the advanced manufacturing systems, or ABC, in cost volume profit analysis. All right, let's move on to the final learning objective. Here we will understand the effect of income taxes on CVP analysis. When you are calculating how many units or how much sales do you need to make in order to achieve a targeted profit, that's when the income tax will have an effect. All right, so let's assume this example of Teddy's Electronics that sells calculators for $50 per unit, and it has variable cost per unit of $35 and total fixed cost of $300,000. So how many calculators should be sold to achieve a target operating income before tax of $150,000? So this is before tax, no tax implication yet. So the normal calculation that we did, the equation will give us 50 times, instead of X, we'll use Q here as quantity. So 50 is the selling price times the quantity, minus 35, the variable cost, times the Q, quantity, minus the 300,000 total fixed cost, should be equal to the pre-tax profit of 150,000. All right, so therefore Q is calculated simply as 150,000, the targeted profit, plus the 300,000 fixed cost divided by the UCM, in this case is $15. So we need to sell 30,000 units or calculators to be able to earn a pre-tax profit of 150,000. In dollars, that would be 30,000 times the selling price of 50, so that's $1.5 million. But what if we are told a different thing? For example, we are assuming here that there is a tax rate of 30%, and we are told that we want to achieve an after-tax profit of 105,000. All right, so how many units need to be sold? If we are told a target after-tax profit, we need to gross up first. How do we do that? So the target operating income, or target before tax profit, is equal to the net income divided by 1 minus the tax rate. All right, so what we'll need to do is to divide 105,000, the net income, the after-tax profit, by 1 minus the tax rate. So 1 minus 0.3 is 0.7. All right, so 105,000 divided by 0.7 will give you 150,000. So once you have already grossed up the after-tax profit, you will just be doing exactly the same as what we did before. The UCM is still 15, all right, and the fixed cost is still 300,000. So we will just be dividing 150,000, the before tax profit. We have grossed up the after tax profit to the before tax profit of 150,000 plus the fixed cost of 300,000 will then be divided by the UCM to give us 30,000 units. That's our break-even point in units. All right. In slide 21, if you can't remember all those formulas that we have used, this is a good slide to go to refresh your memory. All right. Break-even point in units is simply total fixed cost divided by CMU. Break-even point in dollars is total fixed cost divided by CMR, the contribution margin ratio. If you want to earn profit, so targeted sales in units given a targeted operating profit, TOP. How do you calculate? So total fixed cost plus target operating profit divided by CMU. So as long as it's in units, we will divide it by CMU or UCM. They're the same. Contribution margin per unit, CMU or UCM, unit contribution margin. Targeted sales in dollars is simply your total fixed cost plus targeted operating profit divided by the CMR. All right. When there is post-tax profit given, then make sure that you convert your targeted net profit or net income to before tax profit. So it should be targeted net profit divided by 1 minus the tax rate. With multi-product analysis, the formula would be very similar as what we've calculated in break-even point units, break-even point in dollars, but instead of CMU, we'll have to calculate weighted average CMU. All right. And finally, margin of safety is simply budgeted or actual sales minus the break-even sales, and your DOL is simply your total contribution margin divided by operating profit. All right, so let's now do some exercises to apply what we have learned. Here we have the following budget data for Newberry's Nutrition, and we are provided additional information, but let's go to the first requirement. All right. Requirement A asks us to calculate the number of units that must be sold to achieve a targeted after-tax income of $120,000, assuming a tax rate of 40%. All right. So, number of units that must be sold to achieve a targeted profit. So, what do we need to do? We need this one here, targeted sales. All right. In units should be total fixed cost plus targeted operating profit divided by CMU. So let us calculate first our variable cost, fixed cost, variable cost per unit, price per unit, and then the pre-tax profit. So here we are told what are variables. So we'll put variable here and fixed here. Direct materials are variable, we know that. So with direct labor, and so with variable factory overhead, all right, so we'll put that first, 300, 200, and 150,000. For fixed, we have the fixed factory overhead, 100,000, so we have it there. And it seems that marketing and administration is a mix. So let's have a look at additional information. We are told here direct labor workers are paid hourly wages and go home when there is no work. So that confirms that direct labor is variable. The marketing and administration costs include 50,000 that varies proportionately with production volume. So that means out of that 160,000, 50,000 is variable. So we'll put the 50,000 component there, and 160 minus 50 is 110,000. That must be the fixed component. All right, so when we total up, our fixed cost is 210,000 and our variable cost is $700,000. So we need to know our UCM, right? So first thing we need to do is to calculate our unit variable cost. So 700,000 is our total variable cost. So we'll divide that by units to get $7 per unit. What about our selling price per unit? We have sales revenue of 1 million and that pertains to 100,000 units. So that means our selling price per unit is $10. So our UCM must be $3 per unit, right? $10 minus $7. So our UCM is $3. Now, we are supposed to calculate the number of units that must be sold to achieve a targeted after-tax profit of 120,000. So we'll need to gross up 120,000 because that's after tax. To calculate the before-tax profit, we will just have to divide 120,000 by 1 minus the tax rate. So 1 minus 40%, 0.4 will be 60% or 0.6. So 120,000 divided by 0.6 will give us a pre-tax profit of $200,000. So now we can calculate requirement A. What is the targeted sales in units? Well, it's simply the total fixed cost, which we have already calculated here, 210,000, plus the target operating profit, the before tax profit of 200,000. Remember, it's not the 120,000 because that's after tax. All right, so it's the 200,000 that we will add, divided by the UCM that we've calculated here, $3 per unit. So that will give us 136,667 units. Always round up. So let's go to requirement B. Calculate the margin of safety in both revenues and units. So what's the formula for margin of safety? It's simply the difference between what? The current or budgeted sales minus the break-even sales. So we'll need to calculate the break-even point. In units, it's simply the fixed cost divided by the UCM. So we know that fixed cost is 210,000 divided by the UCM of 3. That will give us 70,000 break-even point in units. Currently, we are selling 100,000 units. All right, so 100,000 units minus the break-even point in units of 70,000, so that's 30,000 units margin of safety. Requirement B actually asks margin of safety in both units and revenues. That means in dollars. So we also need to calculate margin of safety in dollars. So that's easy. If we already know the margin of safety in units, 30,000 units, and we know that the selling price per unit is $10, so we'll just multiply 30,000 units times 10, so that's $300,000. All right, so our sales can decrease by $300,000 before losses occur. All right, let's move on to letter C. Calculate the degree of operating leverage. DOL, it's simply the total contribution margin divided by operating profit. So what is our total contribution margin? The budgeted data shows that we have 100,000 units budgeted, and our UCM is $3 per unit. So that means our total contribution margin is $300,000. And what's our operating profit? Well, we are told that the profit pre-tax is 90,000. So we'll just divide 300,000 by 90,000, and that would give us a DOL of 3.33. So that is a nice exercise for the calculation of margin of safety. Let's move on to a problem from your textbook, problem 751. We have Alpine Thrill Ski Company that recently expanded its manufacturing capacity. So the firm will now be able to produce up to 15,000 pairs of cross-country skis of either the mountaineering model or the touring model. So it says either. All right, so either mountaineering or touring model. The sales department assures management that it can sell between 9,000 and 13,000 units of either product this year. Because the models are very similar, the company will produce only one of the two models. So we are provided with this information compiled by the accounting department, and the fixed cost for mountaineering model is given, as well as the fixed cost for touring model. The company, it says here, is subject to 25% income tax rate, and the first requirement asks us to compute the CMR of the touring model. All right, so just the touring model that we are focusing on. Contribution margin ratio is simply the contribution margin divided by sales. So we need to calculate first the contribution margin. So that's selling price of 80 minus variable cost of 52.80. So we'll divide that by 80. All right, and that would give us CMR of 0.34 or 34%. Let's go to requirement 2. If Alpine Thrill Ski Company desires an after-tax net income of 22,080, how many pairs of touring skis will the company have to sell? All right, this is an after-tax net income, so we'll need to gross it up first. All right, so remember the formula for the targeted sales. right, is fixed cost plus the targeted profit, the before tax profit, divided by UCM. So we know the fixed cost for touring is 316,800 is given here. And we know that the after-tax targeted profit is 22,080. So we'll need to gross that up. How? By dividing it by 1 minus the tax rate. The tax rate is given here at 25%. All right. So 1 minus 0.25 is 0.75. So what we're going to do is we'll divide that by the UCM as shown here. All right. So 346,240 is the total of your numerator, and you will divide this by the UCM. UCM being 80 minus 5280 is 2720. So therefore, your targeted number of units to sell in order to make an after-tax profit of 22,080 is 12,730 units, and it's rounded up. Let's go to requirement 3. How much would the variable cost per unit of the touring model have to change before it had the same break-even point in units as the mountaineering model? We'll need to calculate the break-even point of mountaineering model first. So mountaineering model has 369,600 in fixed cost, and it has a UCM of 88 minus 5280. So that's what we are doing here. Divide the fixed cost by the UCM, and 10,500 units is the break-even point for mountaineering model. What do we do next? Let Y denote the variable cost of the touring model such that the break-even point for the touring model should be 10,500 units. So you'll need to do a bit of substitution in the formula here. So then we'll have 10,500 is equal to 316,800, which is the fixed cost for the touring model, divided by 80, the selling price for touring model, and Y is the variable cost for the touring model. All right, that's the unknown. So to substitute, we'll just substitute the formula. 10,500 times 80 minus Y should be equal to 316,800. So therefore, you can actually calculate Y as 49.83 by substitution of the formula. So how do we answer this question now? The variable cost per unit will therefore have to decrease by how much? By $2.97. So the current variable cost is $52.80, and we should reach $49.83. So we'll need to reduce the variable cost by $2.97. All right. Let's move on to requirement number 4. Suppose the variable cost per unit of touring skis decreases by 10% and the total fixed cost of touring skis increases by 10%. We are now asked to calculate the new break-even point. All right, so the new break-even point will just be the fixed cost divided by the new UCM. Well, the old one was 316,800, and it's supposed to increase by 10%. So we'll multiply it by 1.1 or 110%. What about the new UCM? The selling price will still be the same, 80, but the variable cost will decrease by 10%. So 52.80 multiplied by 90%, it will decrease by 10%. So our new fixed cost will be 348,480, and our new UCM will be 3248. Therefore, we'll need to have 10,730 units rounded to break even. All right. And finally, number 5 requirement asks us to suppose that management decided to produce both products. If the two models are sold in equal proportions and the total fixed cost amount to 343,200, what is the firm's break-even point in units? So here is an example of a multi-product analysis because the management is looking at producing both products. The first thing that we need to do is to calculate the weighted average UCM. What is the UCM for mountaineering? It is $35.20, the difference between 88 and 52.80, so that's 35.20. What is the UCM for touring? It was 27.20. 80 minus 52.80, so that's 27.20. And it says that the proportion will be, it says here that the proportion would be in equal proportions. So if the two models are sold in equal proportions, so what is the sales mix? 50-50. So 50% of 35.20 plus 50% of 27.20 is 31.20, and that's the weighted average CMU. So now we will just have to divide the fixed cost by the weighted average UCM, and that would give us 343,200 fixed cost divided by 31.20. So we will need to sell 11,000 units to break even. How many of that 11,000 units is for mountaineering? 50%. So that's 5,500 for mountaineering, and the other 5,500 would be for touring. All right, well, that's it for CVP analysis, and I'd like to close this lecture by introducing you to this Bible verse, Psalms 118 verse 24. It says, "This is the day that the Lord has made. Let us rejoice and be glad in it." So if you're feeling a little bit overwhelmed with the topics we've discussed, it's okay. Take a deep breath and remember that life is really not a problem to be solved. It is a gift to be enjoyed. Let us pray. Our most gracious Heavenly Father, we are ending yet another topic, and we would like to once again close with a word of prayer. Help us, O Lord. Help each and every student. If they are feeling a little bit overwhelmed, I pray that you will give them peace and help them to be able to enjoy life as you have given us, because this is the day that you have given us. We will rejoice, O Lord, and help us to be able to enjoy the gift of life that you have given us. We ask this in the mighty name of Jesus our Lord. Amen. All right, so this is it for topic 7. I will be seeing you shortly. Bye-bye for now.